Hello and thanks for tuning in. Over the past 8 years or so, have you been optimistic about the Eurozone or fearful? My guess, if you follow markets closely, is you've probably been fearful. For years, media headlines have agonized over Greece, Italian and Spanish banks, the Euro's future, deflation, and Brexit, just to name a few. But recently, headlines have started to change their tune, talking up the Eurozone's budding recovery. In our view, the media is actually a little late to the game. The Eurozone isn't just starting to recover or grow. In fact, the Eurozone's in the middle of a broad 4-year economic expansion that most people have missed. In our view, it might be time for investors to take a look at opportunities in broader non-US markets. Let's take a deeper dive. One major reason why folks underrate the Eurozone is politics. With multiple elections slated for 2017 in Europe and many anti-Euro parties gaining popularity, many investors fear those anti-Euro parties could seize power and increase the risk of a Euro exit or worse, a chaotic breakup of the Eurozone. Uncertainty was high when the year started, but as Dutch and French elections passed and centrist pro-Euro candidates won, uncertainty has fallen, sentiment has warmed a little, and stocks have jumped. With elections still to come in Germany and Austria this fall, there's likely more falling uncertainty to come, and that's a good thing for stocks. On an economic basis, Eurozone GDP has grown in 16 straight quarters now, 4 years, and 11 of the Eurozone's 19 members have topped their pre-2008 GDP levels. Even once sagging Eurozone corporate earnings are pointing to strength in Q1 2017, with earnings surging 31% year over year. That figure is well ahead of US earnings, and the trend is expected to continue through 2017. Looking at more forward-looking data, Purchasing Manager Indexes, or PMIs, are surveys that reflect the breadth of growth in the services and manufacturing sectors. Today, the Eurozone Composite PMI has shown more than half of firms reporting growth since July 2013. And Eurozone PMIs have actually hovered near 6-year highs throughout most of 2017. Shifting to sentiment, the political fears I mentioned earlier have kept expectations super low, which is perhaps why Citigroup's Economic Surprise Index shows Eurozone data have topped analyst expectations much more frequently than US data this year. And remember, stocks move most on the gap between reality and expectations, so that bodes well for the Eurozone. While falling political uncertainty has warmed sentiment some, there's still a long way to go. Look at it this way. Continental Europe experienced 2 recessions in the recent past, one from 2008 to 2009 and one from 2011 to 2013 as the sovereign debt crisis wreaked havoc. While world stocks only corrected in 2011, Eurozone stocks actually experienced a full bear market that year. As a result, Europeans are only now starting to shake off their post-crisis blues and fathom the expansion that's actually happening all around them. The Eurozone also seems poised to lead for another reason. It's an inaugural year. In a U.S. president's inaugural year, non-U.S. stocks typically outperform U.S. stocks, in fact, nearly doubling them. And when non-U.S. leads in an inaugural year, first quarters, as they have this year, they go on to outperform U.S. stocks in 9 of 10 such instances historically. So, from a political, economic, and sentiment perspective, we see ample drivers for Eurozone leadership to prove lasting in the foreseeable future. Don't get us wrong though, US stocks could have a very good year in 2017 and the US economy is doing just fine. We simply believe this is Europe's year of falling uncertainty and a time for non-US stocks to shine. That's all for this episode. Thanks for watching.